Let's have some real talk about interest rates. In the mortgage world, we use a term called a par rate. If you get a $500,000 mortgage at a par rate, that means your loan is sold to investors in what's called the secondary market for the same price, $500,000. But if that happened, how would anybody make money in the process of writing a mortgage? While a par rate is technically zero cost to you as the customer, your loan is actually being sold for more than that to the investors in the secondary market, so your mortgage lender can get paid. What's different today is that it's very hard for you as the buyer to get a par rate on your mortgage. Today, it's almost guaranteed that you're going to have to pay some sort of premium or points to secure that rate. Why is that? Well, think about it this way. If you're an investor and you're buying a mortgage loan that is worth $500,000, but you're paying an extra $10,000 or $15,000 for it, how are you supposed to make money? Investors make their money on the earnings on an investment over a specific period of time. Ultimately, the interest rate on your mortgage is reflected in the yield that the investor who buys your mortgage can expect to earn. But what happens if your loan gets paid off early? What happens if interest rates come down? You're most likely going to refinance your mortgage to a lower rate, and the investor is not going to be able to recoup that extra money they paid. So what's the point of all this? Well, while it might seem like a bad thing that you have to pay a premium for a rate today, it's actually a very good sign for the future of interest rates. The fact that investors are not willing to buy loans at par rates today means they believe that interest rates will go down as inflation starts to come down. Investors are charging a premium upfront for rates to make sure they're not losing money on their investment. So my advice today is marry the home, date the rate. If you find a home you love, get yourself into it. Start gaining equity in that investment. The cost savings or the opportunity cost of having a lower interest rate and waiting for that versus building equity in a new asset far outweighed by not getting that home. If you have any questions, please feel free to reach out to me. Love to go over your specific goals.